stats.
Well, for more on Europe's debt crisis, the ABC's business editor Peter Ryan is in Brussels and he joins me now. Peter, good evening. We're hanging on to see a result from the... Peter, we're hanging on to see a result of the vote from the Italian Senate tonight. There'll be a lot of fingers crossed, won't there, that we don't see any surprises thrown up like we saw with Greece?
Oh, Nick, it's really hard to underestimate the importance of this vote in the Italian Parliament, and what's at stake really is the future of the Eurozone and preventing a meltdown of the Eurozone. The Italian Senate is looking at the reforms at the moment. It's hoped that this will finally be passed perhaps tomorrow, and the critical factor is to get to a point where Prime Minister Berlusconi will do as he said and step down, and there will be a new Prime Minister in place in time for markets to open on Monday, and that's what's critical, restoring the certainty that Italy is doing what it needs to do to prevent a meltdown.
And of course markets will be hoping that there will be a plan, some sort of plan in place.
Yes, so this morning, Nick, markets have opened across Europe actually in positive territory, quite different to those very heavy falls we saw a few days ago. Markets have fallen back just a bit, but importantly the Italian share market is up. But what's more important is that bond rates in particular for Italy have fallen back below that critical 7% rate, or that risk factor that borrowers expect to receive for buying Italian bonds. That's most important, and that's a sign that markets are feeling a little bit more confident that Italy is doing what it needs to do.
And of course, Peter, those bond rates are quite crucial for Italy, aren't they? I mean, their problems could become insurmountable if the price they have to pay to borrow money becomes too much for them to essentially repay.
That's right. It's critical that Italy is able to encourage the buying of its bonds. Yesterday, something like 5 billion euros worth of bonds was sold. That was a sign that investors are prepared to take the risk and receive around about 7% in return for stabilising the Italian treasury coffers. But as I said earlier, the most critical thing is for Silvio Berlusconi to go and for a new government to implement the budgetary reforms that are needed to stimulate growth in Italy.
Peter, why are Italy's problems being seen as more of a threat to the Eurozone than, say, Greece's?
Well, quite simply, Nick, that it's been said many times before that Italy's just too big to bail and too big to fail, and the idea of the Eurozone bailout fund being able to bail out Italy, it's just not possible. There's not enough money in that fund, and so everything needs to be done to stabilise Italy. It's the third biggest economy in the Eurozone, and Italy going under or becoming insolvent would really tip the Eurozone into a new level of crisis that would spill over into other stronger economies such as France and Germany, and also the contagion could spread to the rest of the world. We're talking about enormous volatility and a very major fear premium that's being paid, and just this morning the US President Barack Obama has been on the telephone to Nicolas Sarkozy and Angela Merkel saying, please sort this out. We need to have this resolved now. The Eurozone needs to be stabilised. So there are big risks to the United States and also to concerns about a potential slowing in growth in China that would have implications in Australia.
Why is Germany's role so important, Peter?
Well, I think that Germany is really the strongest economy in the Eurozone. It's actually growing. The economy's growing. Its exports are very strong. And Germany itself has a lot to lose if the Eurozone breaks up. And so in Germany there's a very strong campaign being waged by the government to sell the message to German taxpayers that yes, it is painful, yes, it is unpopular for German taxpayers to be guaranteeing European debt, in particular Greek debt, but there's a lot at stake. So Germany really needs to remain strong and solid, and certainly it's the same situation for France, which is under a lot of pressure as well, given that its banking sector is highly exposed to Greek and Italian debt. And we saw a measure of the volatility yesterday when the ratings agency Standard & Poor's accidentally put out a message that was wrong, saying that France had lost its AAA credit rating. That caused a moment of panic. It wasn't the case. France retains its AAA credit rating, but markets or investors are jumping on any piece of news, and something like that could have been a trigger for much worse result than we saw yesterday.
Okay, Peter, without being too glib about it, Europe does tend to remind one a little at the moment of one of those shared accommodation households where a few of the less reliable tenants have blown their rent money, leaving everyone sort of in danger of being thrown out into the street.
Yes, well, Nick, I've been spending a few days here in Brussels as a guest of the European Commission, and I've been spending a lot of time in the European Parliament and inside the European Commission, and I guess that I could sum it up as a bit of an unfunny mixture between the office and yes, minister. There are so many levels of bureaucracy. There are so many people required to do any number of jobs, and this perhaps goes to the perception that there's been so much dithering and lack of unity, a lack of agreement. Seemingly there's an inability for Eurozone leaders to actually get the 17 members of the Eurozone to agree on anything much at all. But financial markets have lost patience a long time ago, and so what's needed now is a very strong result that encourages growth across Europe and, importantly, stops this from becoming a banking crisis.
Okay, ABC Business Editor Peter Ryan in Brussels, thank you very much for talking to us.